In this session, we are going to talk about corporate performance governance and the business ethics. So, wherein we'll look at different kinds of key stakeholders as a part of the business and look at a comparison of their interests and how do their interests typically differ. What are the sources of differences in the interests of the key stakeholder groups? And what is a principal agent relationship here typically with respect to the investment process, and what are the different kinds of problems that can arise with respect to the principal agent relationship. Then moving to the ethics part, what are the main sources of unethical behavior that is being displayed by various managers and investment advisors? Why are they showing an unethical behavior? What could be the typical drivers for this unethical behavior? And finally, we'll be talking about the ethical decision making, different kinds of theories and doctrines that have been proposed with respect to ethical decision making, whether it is a Friedman doctrine or utilitarianism or Kantian ethics, rights and justice theories. All these different kinds of theories with respect to ethical decision making is something that we will be looking at. So, getting started, we know as a part of any business, as a part of any company, the different key stakeholders, you can broadly classify them into external and internal. Internal are the ones who play an important role in the working of the firm, who are the members who are internal to the firm. The shareholders, they are the investors in the company. Employees, they work for the company. Managers, they take care of the day-to-day operations of the firm. Board members, they are some of the major players in the decisions of the company. Whereas you have external guys, customers of the company, the suppliers or the vendors of various raw materials and semi-finished goods, creditors or the lenders of the firm. They are all external parties who have some kind of a vested interest with a particular company. Government, with respect to taxes and with respect to subsidies, benefits, government is involved with the working of the firm. Various unions, trade unions come into picture. The general public, the local community per se, these are the different kinds of stakeholders that are there in the running of any organization. And every stakeholder's interest in the organization are different. Let's look at this. If I look at a shareholder, he wants the share price of the company to grow like anything, or the company should give him more and more dividend so that his wealth is maximized. Whereas on the other side, if I look at the creditor who is a lender to the firm, he wants the company to pay less dividend and retain more of the profit so that the next year the company is more comfortable in paying the interest compared to if it has given more amount in the form of a dividend, because the retained earnings or the reserves are going lesser. So while the stockholders, shareholders want the company to give more dividend, creditors prefer that the company should give less dividend. Conflicting interests. Similarly, employees want their salaries to be increased drastically, whereas the shareholders feel if the company pays more and more towards the salaries of the employees, the expenses of the company typically go up and their share value is going to go down. So, different stakeholders of the firm have different interests on the firm, have different objectives regarding what the firm should do for them, and in some cases we see that all these interests are conflicting as well, and that is one of the prime reasons we are doing a stakeholder impact analysis. Every decision that the firm is taking, we have to analyze what is the impact that this particular decision has on the entire shareholders or on the entire set of stakeholders who are getting benefited, who are getting affected. All this need to be looked at thoroughly. And that is where when we do a thorough stakeholder impact analysis, for every decision that I am planning to take, I have to identify who are my key stakeholders, who are all impacted by this particular decision. What are their interests and what are their key concerns about this particular decision? So, look at what all claims the stakeholders have on the organization. What is that they are expecting from the organization? It has to be evaluated thoroughly. And based on that, prioritize who are my most important stakeholders and from what perspective. So, shortlist the most important stakeholders for the organization, and because some others will get affected, try to assess how much will be the kind of impact that the firm will have because of not satisfying a few other set of stakeholders. So what are the strategic challenges that could come out when one set of stakeholders are being satisfied, whereas the other set of stakeholders are getting badly affected because of the decision taken. Now, the most important scenario that we see in a companies with respect to the clash of interest between the stakeholders is a principal agent relationship. Especially look at a shareholder versus a manager. These are two internal stakeholders of the firm. Shareholder is like investor, whereas manager is like operator. Shareholder may or may not be a manager. Manager may or may not be a shareholder. Right? Or they could both have, one person could be a manager as well as a shareholder. All combinations are possible. But look at it. Investor is a party who has put money in the business. And this party has hired this party to perform the business of this particular firm and generate the profits for the shareholder. So the investor has actually hired the manager to execute the day-to-day operations of the business and produce profits to the shareholder. So the shareholder is typically called as the principal here, whereas the manager is called as the agent. Principal has hired an agent to work on behalf of him and to work as per the interests of the principal and try to generate more profits to the principal. So that kind of a relationship is what we are calling as agency relationship. Especially one party has delegated the authority to operate and authority to make decisions or use the resources, all the resources of the firm. The shareholder has given the right to the manager or control to the manager to use the resources of the firm and generate profits to the shareholder. So that kind of a relationship is called as an agency relationship or a principal agent relationship. So the shareholders and the senior management of the firm typically is this kind of a relationship itself. Now, as long as both their goals are aligned, if both of them think in the same way, then there is no conflict of interest. It will result in the betterment of the firm itself. But if their goals are different, manager does not want to act in the interest of the shareholder, rather tries to maximize his own profit rather than trying to maximize the profit of the shareholder. If the manager tries to take decisions in such a way that he is trying to maximize his own profit, then that is where there is a conflict of interest between the manager and the shareholder. So goals are different. Agents are taking the decision not in the interest of the principal, but they are taking the decisions which are benefiting themselves. That kind of a problem is called as the principal agent problem. And one of the major drivers for that problem is the information asymmetry. Now, if you see, why did the shareholder hire the manager? Because he knows manager has more information, he has more knowledge about the business, so he can take decisions of the business quite effectively compared to the shareholder. So there is the information asymmetry. Manager is having more information about the business compared to that of the shareholder. So there is very much a possibility that the manager will work in order to maximize his own benefit rather than the benefit of the shareholder itself. So one of the major drivers for this entire principal agent problem is the information asymmetry itself. Now that is where when the principal is trying to hire the agent to work on his behalf, some of the key things or some of the key challenges that the principal will be facing is identify the behavior of the agent so that or set the expectations of the agent at the beginning itself while hiring the agent itself. Set it that the agent should act in such a way that the goals which are set by the principal need to be met, not the personal goals of the agent. So try to reduce the information asymmetry to whatever extent possible. Try to bring in right accountability of the agent, or you can even think of giving a share instead of a salary to the agent, or you can bring in some kind of criteria for the performance appraisal of the agent. So there should be some kind of mechanisms where you can even fire the agent in case the agent is found to be not acting in line with the interests of the principal. So that is what has to be looked at in a very detailed manner if we have to address the principal agent problem more effectively. So if we are able to find answers to all these above challenges, if we are able to come out with mechanisms which can address these challenges, then probably the principal agent problem is more or less mitigated and the alignment of the interests of the principal and agent are in the same direction and they both can work towards the maximization of the shareholders' wealth. Now, what could be the reasons why the manager can behave differently? Right? Why is that the manager is not acting in line with the principal, with the goals that are set by the principal? Now, when you use the word unethical behavior, we are talking about a set of principles of doing right or wrong, which actually govern the conduct of a person, profession, or organization. That is what we are calling as ethics. Those set of principles which govern the conduct of a person, profession, or an organization. Now, when it comes to the business, different stakeholders have different rights on the firm. Now, if you look at shareholders, they should get timely information whenever they want, whatever they want. They should get timely and accurate information regarding their investment. And whosoever are the providers of the information, especially the firm or the managers of the firm, they have to typically provide this information as and when requested by the shareholder. Similarly, look at from the customer's perspective, they should have a good amount of information about the products and services that they purchase. The manager should furnish the complete detailed specifications of the products and services that they are going to purchase. Similarly, employees, they have the right on the firm. They should get good working conditions. The working conditions need to be safe. The compensation policy should be clearly defined and clearly implemented. All these things which talk about the rights of the various stakeholders, how well the company is implementing all these things. Whatever it has mentioned in the beginning, is it sticking to all these things? Is it deviating from all these things intentionally? So that is what will define the unethical behavior of that particular person or a firm. So some of the basic ways where you look at unethical behavior that can crop up. So managers, they try to put their personal goals much ahead of the rights of any of these stakeholders. So rather than trying to explain the customers about the products or services, they are busy in terms of maximizing their own profit, trying to hide the features and functions of the products that they are selling. There could be a possibility of self-dealing, which is more like internal trading. They allot the more and more shares to themselves at much lesser prices, so that because they know what the company is going to do in the future, so they try to maximize their position accordingly. They try to manipulate the information, and the way they present the information to the public, they try to manipulate that information, or they act in an anti-competitive manner. They try to suppress the competitors through their various strategies. They try to monopolize the whole industry. So, trying different kinds of mechanisms of removing competition from the process, or get into opportunistic exploitation in the value chain. Try to exploit your suppliers or try to exploit your customers through various mechanisms, and try to act unethically. Working conditions are very much substandard. Don't try to improve any of those working conditions. Kind of harassment that you have on the employees, all these things, they are some kind of indications of unethical behavior of a particular firm, or the management involved in the corruption practices, briberies, and even they are not contributing anything to the environment in terms of dumping waste and all, which are also a part of the unethical behavior of the firm. And what could be the prime reasons? We should understand business ethics are not much different from personal ethics. Means it's the personal character of a particular person, whether he is a leader or any member of the organization. It is his personal characteristics that get translated into the business environment base. So try to assess what is the personal behavior of the person before you get into the recruitment process. Because business ethics can't come out, a business unethical behavior cannot typically come out from a very ethical person in the any very ethical person on a personal front. So these two cannot be possible. Business wise unethical, but personal wise ethical, or vice versa. This kind of scenario cannot be possible. And the other possible reason could be the business sometimes does not realize that they are behaving unethically. In some cases, it's very, very difficult to differentiate between strategy and ethics. So, in some cases, it is very difficult to really realize that we are doing something unethical. Even in some organization, the organization climate, it does not encourage people to really think what could be the ethical consequence of this decision that we are taking. So even the environment and the culture in which the business is being performed also could be a problem of this unethical behavior. Even the organization culture, it is de-emphasizing the business ethics, because whatever decision that you are taking, for them it's a economic decision. It's a business strategy. So they really don't bother too much about the word called ethics. And in some cases, it could be a pure pressure from the top management that I have to meet these goals. And if I am very, very ethical, I can't meet these goals. So, which means I have to resort to some sort of unethical behavior itself if I have to really meet my business goals. So, all these could be the various reasons why people or businesses act unethically in some scenarios. And if all these are typically driven by unethical leadership, then probably there is no end to this unethical behavior in the organization. So, if you have to be very ethical, what all can be done? I have to hire right set of people. Even the kind of increments, incentives, the promotions that I give to the people, it should be heavily weighted on ethics rather than the business results. Business results in an ethical way should be the criteria for promoting a person. Look at the organization culture, build it purely, heavily built on the ethical behavior. Make sure that the leaders, the top management, they just don't keep preaching ethics, they follow them rigorously. Every decision that we are putting in place, you should ask people to question the ethical significance of each and every decision. Could there be any kind of ethical problem that can crop up because of the decision that we are taking? If possible, hire ethics officers or compliance officers whose major role is to look at every decision from an ethics perspective. The governance processes should be very strong, and finally act with a moral courage. So all these things should be very much developed if you are interested in developing an organization which is high in ethical aspects. Now, with respect to the ethical decision making, we see different kinds of doctrines and theories that have come up. Look at the Friedman doctrine, which says there is only one social responsibility of the business. Simple way of looking at the business, you try to meet your single social responsibility. What is that? Whatever the resources that you are using from the society, whatever the business activities that you are engaging yourself in, the intention is yes, its profit should go up as long as it is within the rules of the game. Means don't try to knock out your competition. Let the competition be open and free. No deception, no fraud. Without that, as long as you are able to generate your profits in a socially ethical kind of a manner, that organization is an ethical organization itself. The other side we find utilitarian ethics. Utilitarian is itself means equality. So what this talks of is the moral worth of the actions that are being implemented are purely determined by their consequences. Whatever are your actions, they drive the various consequences. And as a business, you should be maximizing the good and minimizing the harm. So whatever the decision that you are taking, the good should be a more in it, very limited amount of harm to any sections of the society. So you have to carefully weigh all the social benefits because of every decision and what is the cost because of that particular decision to the society, and only implement those decisions where the social benefits are much higher compared to the social costs. So your target should be the greatest good should be produced for the greatest number of people. Even if some people are getting affected, fair enough, but try to look at the greatest good for the greatest number of people. So that is where it does not consider the justice theory, which I am going to talk about in the next slide. But this is what is utilitarian way of talking ethics. Then we have a Kantian way of talking ethics. What it says is people should not be treated as a means to the ends, but they should be treated as ends itself. So they have dignity. We need to respect them. It's not that you make them work for hours and hours in the mid sun and you don't pay them anything. Pay them peanuts. Now that is where we talk about the dignity and the respect that needs. That is also the Kantian ethics says it is unethical. Then coming to the few other theories, the rights theory. So it says you need to emphasize on every human being having his own set of rights and privileges. He has right to freedom. But that doesn't mean that he can insult others, right? It's he can execute his own rights by respecting the others' rights as well. So there is a minimum level of morally accepted behavior that we expect, and the fundamental human rights are typically the moral compass for the managers to take the decision. So you should make sure that every decision that a firm is taking, it should not violate the fundamental rights of the various individuals. Whereas the justice theory simply says the distribution needs to be just, fair and equitable. Everyone should get equal amount of goods and services. Unless when you really find if the distribution is unequal, it will really help everyone. Unless you are very well convinced with that aspect, all the goods and services need to be equally distributed to everyone. That is what is being proposed by just justice theory. So you have different kinds of economic related fundamentals which also influence the ethical way of making decision. Now this is what we have tried looking at in this session. If you have any further queries, you can very well get back to me by giving me a call on the number provided below, or you can send in an email at vamsizar@facegurus.com. Thanks a lot for listening to this session. Thank you very much.